Hello students, now let's start with the third lecture of this particular module. In the previous lecture we have gone through certain formulas. Now in this particular module we are focusing on the concept of efficient frontier and how to go for the optimum portfolio selection. Now what is the efficient frontier? The efficient frontier is a central concept that has been given by Henry Markowitz. So on the basis of this efficient frontier, fund managers as well as investors select their portfolio. So with the help of this lecture, I am going to tell you how to calculate the efficient frontier and how to select a particular portfolio. So efficient frontier represents the set of optimum portfolios that offer the highest expected return for a given level of risk or the lowest risk for a given level of return. So what we need to focus? Either we focus on the risk or we focus on the return. So it depends upon an investor, either he wants to focus on risk so that the risk must be lowest and he should get maximum return out of it, or he should focus on return, the highest return at most or the least possible risk. So on the basis of that, a particular portfolio is designed. So we have gone through the calculation, how we going to calculate a particular risk of a security and how we going to form a particular portfolio by selecting a particular securities in the portfolio. Suppose there are 3 stocks, we are going to compare it A, B and C, we are going to calculate the expected return of individual securities. Then we, on the basis of the covariance and portfolio risk formula, we are going to select a combination that is either A or B or C or A or C. So it depends upon the investors how he going to allocate the securities and what will be the proportion of security that he may also change, and accordingly he can form a particular portfolio. So it serves as a benchmark for evaluating portfolio performance and constructing an optimal asset mix. So I have already explained that suppose if there is 3 stocks available to a particular individual investor, he wants to invest 60% in A, 15% in B and 20% in C. So total is 100%. Now on the basis of this, what he is going to do? He is going to select certain combinations, and this combination are 60%, 15% and 25%. He is going to calculate the portfolio risk and portfolio return, and then he form a particular portfolio. Suppose this name of the portfolio is P1. Similarly, he is going to change the composition ABC as there. Now 50%, 25% and 25%. This portfolio is termed as P2. Again, he is going to change. The third combination is A, B and C. Now the combination is 40%, 40% and 20%. So this is P3. So similarly, he is going to develop certain portfolio on the basis of different weights, and suppose we have P1 to P10. Now we are going to put this in the form of risk return graph, and on the basis of that we are going to develop a efficient frontier. So portfolios below this curve are suboptimal because they don't provide enough return for the level of risk. If we go through this particular portfolio, so these are P1, P2, P10, P9, P8, P7. So these are certain portfolios that has been developed by an individual investor. And then we have to draw this efficient frontier. This is termed as efficient frontier. So portfolios below these lines, all these portfolio P1, P2, P9, P10, P8 and P7 are basically providing less return to the investor, but the risk is very high. In this case of P1, P2, this is also termed as minimum global variance portfolio because it is having less risk and less return. So this is a global variance portfolio. At least an investor should get this much return at this much risk. So if a risk aversive investor is there, in that case he is going to invest in this particular portfolio. If an investor is risk taker, in that case he is going to select a portfolio over this particular point, because it is going to give him higher risk as well as higher return. If a person is risk neutral, he is going to select either this particular portfolio or this portfolio, because they are giving him having less risk and higher return. So it depends upon a particular investor how he is going to select his portfolio depending upon his nature. So I have shown you the picture of efficient frontier. Now you are able to understand what we are talking about. While the benefits of diversification are clear, investor must determine the level of diversification that best suits them. How much he wants to diversify, we are going to talk in the asset allocation strategy, that whether he is following a tactical strategy or balanced strategy. Whatever strategy is following, however he is developing his diversification, he need to understand the basic concept that he needs to reduce the risk and maximize his return from a particular portfolio. So this can be determined through what is called efficient frontier, a graphical representation of all possible combination of risky securities for an optimum level of return given at a particular level of risk. So we have already mentioned that at a higher level of risk we are getting higher return, but it depends upon the investor whether he is interested in taking higher risk or not. So again, risk tolerance levels will be evaluated, and on the basis of that an investor decides whether he go for higher risk risky instrument or lower risky instrument. So at every level of return, investor can create a portfolio that offers the lowest possible risk. So we need to understand that in this particular graph it is mentioning volatility and it is mentioning the expected return. So here is the expected return. These are certain points, suppose 5%, 10%, 15%, 20%, 25%, 26% and 30%. So these are the categories of returns on the basis of which he can decide whether he is interested in 1% standard deviation, 0.2, 0.3, 0.4 or up to a certain limit. So it depends upon the investor whether he wants an instrument which is providing him higher returns at lowest possible risk or providing less return at highest level of risk. So it is depending upon the investor. For every level of risk, investor can create a portfolio that offers the highest level of return. So again, at lowest level of risk also we can create a maximum return portfolio, because we already know that at low level the amount of return is also low, but that must be highest for that particular investor because he is risk aversive by nature and obviously is not interested in taking higher risk. So whatever return he is getting is the highest for that particular investor. So he has to compare if a risky level is 1 standard deviation, 0.1 standard deviation, he can go for 5% return or 4% return or 3% return. Obviously, he is choose the highest return at this particular standard deviation. This is standard deviation, then this is return. So he is choose 5% return. So this is up to an investor how he decide his optimum portfolio. It is again decided on the basis of risk nature, that is risk aversive or risk taker. So we need to understand these two fundamentals while going for selecting a particular portfolio. So portfolio found on the upper portion of the curves is efficient as it gives the maximum expected return for a given level of risk. So efficient frontier offers a clear demonstration of power behind diversification. So if we go through this particular diagram, we can see all these blue dots have been developed by an individual investor or a fund manager on the basis of correlation, covariance and portfolio risk and portfolio risk and portfolio return calculation. So these are basically the portfolio risk and portfolio returns that has been presented in x-axis and y-axis. So on the basis of all these calculation, the investor has selected this particular blue dots and it is presented in this graphical manner so that he can understand which particular portfolio is best suited according to his risk appetite. So any portfolio that falls outside the efficient frontier is considered suboptimal for one of the two reasons. First, it carries too much risk relative to its return, or too little return relative to risk. So if any particular portfolio that is outside the efficient frontier, means these portfolios P2, P9, P8 and all the dots that are coming below the efficient frontiers, or suppose certain dots are above the efficient frontiers, these portfolios are risky for the investor. So he can reject this particular portfolio to select the optimum portfolio that are available on this particular green line, that is on the dots like this one and this one. These are the optimum portfolio. He can select any of the portfolio according to his risk appetite or risk tolerance. So the portfolio that lies below the efficient frontier doesn't provide enough return when compared to the level of risk. Portfolios found on the right of the efficient frontier have higher level of risk for the defined rate of return. So if we go through this particular thing, these portfolios are providing higher return, and at the same time they are having a higher risk also. And if we go to downside, we can see the risk level is low and they are also providing lower level of returns to the investor. So there is no singular efficient frontier because investors can alter the number of characteristics of the asset to confirm their needs. So it depends upon the investors how he going to channelize this particular portfolio. He can channel, I have shown you the examples that what is the proportion of ABC in the portfolio, or he can change the composition to A and B also, and on the basis of that he can create n number of portfolios depending upon his requirement. So at every point on efficient frontier, investor can construct at least one portfolio from all available investments that feature the expected risk and expected return corresponding to that particular point. So you have seen there are lot many portfolios that has been created by combining only two assets or by combining three assets. So it depends upon the investor how is going to formulate this portfolio. So investor can create a number of portfolios by combining changing the composition of or the proportion of individual weights in the portfolio, and then putting into the efficient frontier and draw this efficient frontier line, and then check which portfolio is best for the investor. Now coming to the next concept, that is optimum portfolio selection. Okay, now coming to the next topic, that is optimum portfolio selection. How are we going to select the optimum portfolio on the basis of efficient frontier? We have seen that an individual investor can draw the efficient frontier very easily, but how is going to select it? On the basis of his risk tolerance, we are going to select it. Okay, so efficient frontier provides investor with a guide for selecting optimum portfolio based on their risk tolerance. So I have already mentioned that on the basis of risk tolerance only we are going to calculate how much risk we are going to take and how much expected return we expect from a particular portfolio. So first is investor risk preference. It is characterized, or we can classify it into two categories, that is risk averse and risk taker investors. So risk averse investor prefers portfolio closer to minimum variance portfolio. What is the minimum variance portfolio? This is the minimum variance portfolio because at this point this is the minimum variance portfolio. After this point the line is shifting tremendously. So at this particular portfolio the amount of risk is low. We can see the amount of risk is quite low and the return he is getting is quite high as compared to other instruments. So this is the particular portfolio which is sought by risk aversive investors. And risk-seeking investors aim for portfolio that offer higher expected return, accepting the increased risk. So if we look at the figure, so they may select this particular portfolio or something like here where the expected return is high, because we can see the expected return is high over here and the amount of risk is also high. So whenever we are talking about the concept of optimum portfolio, we have to see the portfolios that has been drawn on the efficient frontier, and on the basis of that we are going to select which particular portfolio is suitable for different type of investors. So an individual indifference curves which represent combination of risk and return that yield the same level of utility are superimposed on the efficient frontier to identify the portfolio. So on the basis of efficient frontier, now what we are going to draw to identify the optimum portfolio, we are going to put the indifference curve of individual investors for risk aversive investor as well as for risk seeking investors or risk takers, so that we can understand what is the basic utility or basic requirement of individual investors from a particular portfolio. So these are two particular indifferences curves. First one is risk return indifference curve. In x-axis we have risk, in y-axis we are presenting expected return. These are two investors, IQ and IP. P and Q are the investors and they have their indifference curves. In this particular indifference curves, we are presenting the utility curves of investor P, where it is going upward, the expectation is going high. So in x-axis again we have standard deviation, in y-axis we have expected return. Now I am going to explain this particular concept. So in figure 1, indifference curve which reflect risk return trade-off functions, here all the points lying on the indifference curve provide the same level of satisfaction. So whatever the points put on over this particular curve, we can say that it is going to provide same level of satisfaction to the investor. If you have gone through the concept of indifference curve in economics, you know that a single indifference curve, whatever points are put on over, it is going to provide the same level of satisfaction to the investor. In case of P, if the points are here, 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 we can say suppose 1, 2, 3, 4, all the points 1 to 4 are providing him same level of satisfaction. In case of Q, suppose these are the points, so it is suppose A, B and C, it is also providing him the same level of satisfaction. So this particular utility curves are of two different investors. So both P and Q, like most investors, are risk averse. They want higher returns to bear more risk. So Q is however more risk aversive than P. Why it is so? Because his indifference curve is higher than P. So he is more risk aversive in nature. Q wants a higher expected return from bearing a given amount of risk as compared to P. So we can see in case of P, he is expecting a higher level of return, but his risk tolerance level is high as compared to Q, where his risk tolerance level is low. This is P, his risk tolerance level is high as compared to Q, whose risk tolerance level is here. But both of them are expecting the higher returns from their investment, depending upon the amount of risk they are going to take. So in general, the steeper the slope of indifference curve, the greater the degree of risk aversion. So higher the slope or the steeper the slope, the risk aversion level is greater in that condition. Now each person has a map of indifference curve that is shown in figure 2. We have seen that there are different maps for investor P. So in that particular indifference curve, there are 4 maps, that is P1, P2, P3, P4. All the points lying on a given indifference curve offer the same level of satisfaction. So for example, point A and B, which lies on indifference curve P1, offers the same level of satisfaction that A and B. Similarly, R and S are providing the same level of satisfaction which is lying on indifference curve P2. The concept is similar to say indifference curve that we have studied in economics. The indifference curve P2 represent a higher level of satisfaction as compared to indifference curve P1, and P3 is again representing a higher level of satisfaction when compared to P2, as it is going upwards or it is moving upwards towards left. It is providing them the higher level of satisfaction. So we can say the P4 indifference curve is providing higher level of satisfaction as compared to, or higher level of return as compared to P1. Now when coming to the efficient frontier, when we apply this particular concept, we are going to put all the indifference curves over in the particular graph. So this is Q1, Q2, Q3 are the indifference curve of investor Q, and P1, P2, P3 are the indifference curve of investor P. Now we are putting this particular line, that is this particular line is the indifference efficient frontier. These are certain portfolios that is put in over here. It is looking like an umbrella, but it's not an umbrella. These are basically the portfolios that has been put on different points. So given efficient frontier and risk return indifference curve, the optimum portfolio is found at the point of tangency. Tangency means this particular indifference curve, that is Q2, is touching the efficient frontier at point Q. Similarly, the indifference curve P2 is touching the efficient frontier at P star. So these are the points that are optimum points for the or optimal portfolios for the investor. So this point represents the highest level of utility the investor can reach. The figure 3, two investors P and Q confronted with same efficient frontier but having different utility indifference curves. We already said that P1, P2, P3 and Q1, Q2, Q3. Both the investors are different but having same efficient frontier. Now what they are representing? They are providing the highest utility at point P star and Q star. Now this tangency point, what is it showing? So tangency portfolio and the capital market line is the next concept. I think you are clear with the how we are going to evaluate the optimum portfolio on the basis of indifference curve, and we have categorized investor in two categories, that both of them are risk aversive by nature, but one is more risk aversive as compared to other one, and how they are putting the indifference curve on the efficient frontier line and how they are identifying their optimum portfolio. Now coming to the next concept, that is tangency portfolio and capital market line. So if a risk-free asset is introduced like treasury bill, what will happen to the efficient frontier? The efficient frontier becomes a straight line known as capital market line at that point of time. It will look like something like this. So when the risk-free instrument is introduced, the point will start from this particular point S, B and X till the point we have the risk-free securities in the portfolio. It is again a very important concept in case of capital asset pricing model, where this particular concept of capital market line is also introduced. So capital market line starts at the risk-free rate and it's tangent to the efficient frontier at a point called tangency portfolio or market portfolio. So the tangency portfolio has a highest Sharpe ratio, making it an optimal risky portfolio when combined with risk-free assets. So figure 3 assumes that all the securities on the efficient set are risky. Let us introduce yet another opportunity where we are going to see how the investor borrow the money and go for the risk-free instrument, that is shown in the next figure. So since RF is a risk-free asset, it has zero correlation with all the points in the feasible region of risky portfolios because it is totally different from the risky instrument. So we need not to calculate or go for calculation of correlation and covariance in case of risk-free instrument and risky instruments. So combination of RF and any point in the feasible region of risky securities will be represented by a straight line, as I already pointed out that this is the risk-free instrument line, or we can go for this particular 1 and 2. So consider point Y. This is the Y point, a portfolio of risky securities because it is below that particular line. The investor can combine RF and Y and reach any point along the straight line. This particular straight line can be reached out if he is interested in having a particular portfolio of Y and RF. So even beyond, to go beyond, they can leverage this particular portfolio, so they can go for M also. So it depends upon the investor how much riskiness he is interested in taking. So he can choose a particular risk-free instrument. He can choose a portfolio that is located at point Y, or he can go for M security also in this particular line. Although the investor can reach any point on line 1, no point in this line is an optimum point because it is not tangent to the RF line. So we cannot say at this particular point he is getting any portfolio that is optimal for that particular investor. To see this, consider line 2. If we go to this particular line, here we can see that S is a particular security which is giving the optimal return to the investor. To this runs RF to S. If we go for RF to S, and beyond this the line 2 is tangent to the efficient frontier, and it is giving the possible opportunities to the investor because this particular efficient frontier is tangent at this particular point. So we can see that line 2 dominates because in line 1 there is no optimal portfolio because it is not tangent to the risk free assets. But in case of line 2 it is tangent to that risk free asset, and we are getting a optimal point over here or tangent point over here, or we can say the interaction point between RF and risk free instruments and the risky instrument. So it becomes a optimal portfolio reason. So we can see the line 2 dominates line 1. For that matter, it dominates any other line between RF and any point in the feasible region of the security. So thus the opportunity of lending and borrowing, the efficient frontier changes. It is no longer the AFX, rather it becomes AFX. It is not like this that we need to borrow this particular line, that is curved efficient frontier. Now our line is RF, S and X. So we change from RF, S and G because RF, S, G dominate AFX. The curve is now like this. So it becomes this particular straight line. Initially when we started with risky instruments, we are having a curve like situation. Now our curve become a tangent line, that is tangent to the efficient frontier, and it becomes a straight line. So RF, SG is providing us the best return. So for every point on AFX excepting X, there is at least one point on RFSG which is superior to point AFX. So since RFSG dominate AFX, every investor would do well to choose some combination of RF and S. Why it is so? Because it is going to give them optimum return. And when we are talking about diversification, we should comprise our portfolio of bonds as well as the risk instruments. So here what we are doing, we are combining bonds as well as, or we can say the treasury bills as well as the risky instrument, and it is giving us the best returns. So a conservative investor may choose a point like U. If we go back, he is going to choose a point like U where he is totally investing in risk-free instruments, and whereas the aggressive investor may choose a point like V. If we go to this particular point, this point is termed as V. So it is, we can check this, a particular investor who is risk aversive, he is going to choose U. If a particular investor is risk taker, in that case he is going to choose this particular point. So both the investors choose a combination between RF and RS depending upon his riskiness. So while conservative investors weight RF more in his portfolio, aggressive investors would weight S more in his portfolio. So S is basically the risky assets, and RF are the risk-free instrument. So it depends upon the characteristics or risk tolerance of the investor, how he is going to choose the optimum portfolio. So when we incorporated the risk-free instruments in the efficient frontier, we are able to see that the frontier from the curved to it changes to a straight line, and on that straight line the investor is able to choose his optimal portfolio depending upon his risk appetite. So thus the task of portfolio selection can be separated into two steps, that is first identification of S, the optimum portfolio of risky assets, and choice of combination of RF and S depending upon his risk attitude. So we can easily select the securities on the basis of this optimum portfolio where we introduce the concept of risk-free instrument. So we simply say that if we introduce the concept of risk-free instrument along with risky instrument, we can easily go for selecting an optimum portfolio which comprised of both secured securities, or we can say the bond based securities as well as the risky securities. So this is the import of celebrated concept, that is separation theorem, or we can say the two fund separation model that has been given by James Tobin. We are going to elaborate this concept in next lecture. So coming to the next topic, that is some practical implication of efficient frontier. The first thing is guidance for asset allocation. On the basis of this particular concept, I think you have understand how we are designing the portfolios, how we are incorporating the risk-free assets in the portfolio, and how we are combining these two assets so that we can get an optimum portfolio. So it provides a guidance for asset allocation. Adjusting for investors preferences, so we can assign the portfolio according to our requirement. If investor is risk aversive, he can do accordingly, and if he is a risk taker, he can do accordingly. So weights are assigned to align with the efficient frontier, and accordingly he can select the portfolio which suits the investor best. So it helps in designing strategies based on individual risk tolerance, as the shape and slope of efficient frontier illustrate the diminishing marginal returns of taking more risk. Then problem in real world application. In practice, accurate estimating the expected return, variances and covariances need to construct the efficient frontier can be challenging because it is a tricky task. I have already mentioned that for individual investors, it becomes difficult to calculate the correlation and other things, but for fund managers it is easy, but in real world it is difficult for application. If an individual investor is going for calculating all this thing, it becomes little bit difficult and harder. So with this we come to end of this particular topic. Thank you.